Have you ever wondered what it means when we talk about the cost of capital in healthcare? It's a fascinating subject that is central to understanding the financial health and strategic direction of both for-profit and non-profit healthcare systems. So, what exactly is the cost of capital? It's a term used to describe the cost of a company's funds, both debt and equity. In simple terms, it's the minimum rate of return that a company needs to generate from its investment projects to maintain its value and attract further investment. Now let's break down the two main components of the cost of capital, the cost of debt and the cost of equity. The cost of debt is relatively straightforward. It's the interest a company pays on its borrowings. This could be on loans, bonds, or other forms of debt. The cost of equity, on the other hand, is a little more complex. It represents the compensation to the equity shareholders for their investment and risk. The cost of equity is usually higher than the cost of debt, as equity investors bear more risk than debt holders. In the context of healthcare, the cost of capital is a critical aspect of financial management. For-profit healthcare systems, like hospitals or medical device manufacturers, use the cost of capital to evaluate potential projects and investments. It helps them determine whether a new hospital wing, for instance, would generate enough return to justify the investment. Non-profit healthcare systems, such as public hospitals or community health centers, also consider the cost of capital, but with a different perspective. For them, it's more about ensuring sustainability and ability to provide essential services to the community. And then, there's the concept of the weighted average cost of capital, or WACC. It combines the cost of debt and equity, giving each a weight that reflects its proportion in the company's capital structure. WACC provides a comprehensive view of the cost of capital, helping healthcare organizations make informed decisions about investments, budgeting, and strategic planning. As we delve deeper into the cost of capital, it's time to equip ourselves with the mathematical tools needed to crunch these numbers. Don't worry, you don't need to be a math whiz to understand this. We'll break it down into simple, easy-to-understand steps. First, let's tackle the cost of debt. It's calculated by multiplying the debt interest rate by 1 minus the tax rate. This formula considers the tax shield provided by interest expenses, effectively reducing the cost of debt. Next, we have the cost of equity. This is a bit more complex as it involves the capital asset pricing model, or CAPM. The formula is risk-free rate plus beta times the market risk premium. Alternatively, it can be calculated as the cost of debt plus the market risk premium. Now don't fret if these terms sound alien to you. We'll discuss each of these components in detail in our next video. Finally, we have the WACC. To calculate this, you multiply the cost of equity by the proportion of equity in the capital structure, and add to that the cost of debt multiplied by the proportion of debt in the capital structure. This gives us a comprehensive view of the cost of capital, taking into account both debt and equity. Remember, these calculations give us a quantitative measure of the cost of capital, which is a key factor in making strategic financial decisions in healthcare. Now that we're armed with these formulas, let's continue to our conclusion. In summary, the cost of capital serves as a crucial tool in healthcare finance. It provides a benchmark for evaluating potential investments, helping healthcare organizations balance between risk and return, and ultimately, ensuring their financial viability and ability to serve their communities. So, the next time you hear about a new hospital wing being built, or a medical device company launching a new product, remember the cost of capital played a major role in that decision. Understanding this concept not only gives you an insight into the financial workings of healthcare organizations, but also underscores the importance of wise financial management in ensuring quality healthcare for all.